Welcome back to Growing Quality, and it has been an interesting week in the markets. Now, a lot has happened, and I want to go over some of the highlights of it. Now, starting off, I want to talk about Jerome Powell because he has made some comments during his speech regarding the interest rates decisions, and I want to talk to you about what happened there and how I think about it. Now, PayPal has released their earnings, and it is my largest position, so it's only natural for me to go over it and to give you my opinion. Then I want to talk about Apple because they just released their earnings as well, and well, Apple is a hugely important company in the market. Then I have two companies that I generally don't like. I genuinely don't like them, and that's Square and Carvana, and it has all to do with their reportings. So I want to go over those two as well and warn you of some things that I see in their earnings reports. And then to close it off, I have some exciting announcements. So Wednesday we had the rate hike decision, or lack thereof, as rates stayed leveled as they were, and this was all very much expected. Now, investors and analysts feared that Jerome Powell may have missed that CPI was rising again and that we had some, well, generally hot data points, economic data points, and that he was keeping his eyes shut to those facts. So markets were nervous going into the report, but when Jerome Powell actually started speaking, he started to acknowledge um, these data points. And that, of course, was very, very good for him. And stocks also reacted very favorably to it. Okay, so if we look at what happened when Jerome Powell started his speech, we can see that stocks initially jumped up quite well. Now, this is a chart of Enphase intraday, it's a 1 minute chart, but we also had PayPal. They all ran up as Jerome Powell started his speech and gave his speech. And the longer the speech went on, the more dovish he started to sound, or maybe not dovish, but realistically dovish, because he acknowledged the fact that CPI was creeping up. He acknowledged the fact that employment numbers were coming in on the strong side, but he said he didn't really see an issue there. It was all kind of expected. He even went as far as saying that the next rate move he expected would be down and not up. Now, of course, analysts and journalists wouldn't have their job if they didn't try to pick out the bad stuff. And that's where they find that he did not say that he expected to cut rates this year. And that is why you see these downtrends at the end of the day. Okay, so let's think about what he didn't say then. Because as he did not mention that he expected a rate cut this year, let's rationalize it. Because if you think that you can go down from the inflation levels that we have seen and glide it all the way down to 2% without any hiccups for that soft landing, I think is a mistake. Because it would make no sense for me or to me that you have had such a high level of inflation, then do all this tightening in the economic markets just for you to say, okay, we're gonna calmly go to 2%. That makes no sense to me. And maybe it does to you, but to me, it sounds a bit like a fairy tale. And the question is also if you want or should want the rate cuts, because having rate cuts also means that either, okay, you may have that 2% soft landing, but in any other case for rate cuts, it's actually a bad thing because that means you have to stimulate the economy because the economy is going to a worse place. And that should be the last thing you want. Now, markets have been pricing out that rate cut, in my opinion. And that's why we have seen stocks going down yesterday. However, in my opinion, that meeting, that speech of Powell was very good. He sounded quite dovish to me, and it made me reduce my cash position for a large part. it has given me the confidence to say, okay, he acknowledges the problems that he sees or we see as investors, but he just stands by his choice and he is analyzing it, he sees it, he acknowledges it, and that's a good thing. That's overall a very good thing. Do I expect a straight path up from here? No, because analysts will always try to find ways to sell fear or uncertainty. But all in all, I think markets will start to climb back from the little pullback it has had due to the uncertainty of the markets. Now, it also means that we have come down from those peak greed sentiments. And I think we can start climbing back up and look to the upside again. Okay, so then we go to the PayPal earnings, which, in my opinion, were a great success. I think the numbers looked great, and I think that what Alex Chris is doing over there is really starting to pay off. Now, when I first saw the number, I was a bit in shock because I got a notification of my phone that EPS numbers came in at $1.08, where $1.20 was expected. I opened my phone and I saw the stock down 4.5%, and I thought, here we go again. But then I looked into the earnings report and I was quite surprised because, of course, what I forgot is that they started their new way of reporting their numbers. They have this new methodology where they do non GAAP numbers and include stock based compensation in it, which previously was excluded. Now, all the way at the bottom of the release, they also put the comparable numbers, so when they included stock based compensation. But those numbers were actually really, really, really good. And there were a number of reasons for it. But let's first just go over the things that I saw and found most notable in the earnings report. Okay, so let's just go through it together. Starting with this slide I got from their report, in which they said they delivered Q1 results ahead of guidance. And I think they did, indeed. They delivered them ahead of guidance, although not by the first look of the numbers. That's already what I told you. I saw the stock selling off. And also me, I thought, here we go again. But they actually somewhat did. Okay. So they are accelerating the speed of execution. This sounds logical to me because they have been laying off a bunch of staff. So sure, they have been leaning out, which means shorter connections between people, and that's overall a good thing. Now, they also say that they are aligning employee incentive plan metrics to profitable growth and shareholder value creation. So, what do they mean by it? Well, they are not just going to give out stock based compensation to everyone who think they might like to have it. That's basically what they are saying. They are also holding themselves very much more accountable by including it into the non-GAAP numbers. Now, this also has some implications for the share price, but we will get to that later. First, let's just go through this. Okay, so they also restated their priorities for full year 24, and they want to operate more efficiently. That's a noble plan. And does that mean that they are going to lay off even more people? Well, possibly. But let's just go through it and go to the next slide. Okay, so we have the Q1 24 earnings snapshot, and there are a couple of things you have to look for in this slide. So let's first look at total payment volume because this increased 14%. That's good. We have revenue, 9% and 10% on a currency neutral basis increase. So that's also very good. And then the non-GAAP EPS of $1.08. Now, we also can see that in this slide, they also included the old number or the number under the old methodology. And there we can see that it came out to $1.40 compared to the $1.20 expected and $1.17 last year. So under the old methodology, they already increased their earnings or their non-GAAP EPS by 20%. But now if we look at the new methodology, it becomes even more impressive because now they increased it to $1.08 from 85 cents, or an increase of 27%. And of course, it's not like they improved the business by 27% or not grown by 27%. This is just performance numbers. They laid off a bunch of stuff. Um, but it does give you an insight into how well the turnaround is going. Okay, so Alex Chris has been pushing the idea of profitable growth. And if we look at the numbers, we can see that he is actually quite doing so. We can see non-op or non-GAAP operating income improving and the margin, because right now it's at 18.2%. As we already mentioned, the non-GAAP EPS increased by 27%. And transaction margin is also increased a bit. Now, is this all that impactful? A bit, not to the extremes. And that's also because this is all coming just from operational improvements, basically. Because all the new innovations that Alex Chris is trying to push is barely in this. Now, they did mention that they are especially bullish on the fast checkout innovation that they pushed. Now, regarding those new innovations, the team said that they see a lot of enthusiasm about the fast lane product that they have been pushing, and that this is helping merchants a lot. Now, this is of course very good, but it hasn't really been taken into any of the projections for this year. So that will just come, basically every result from it will come on top of what they are expecting. Okay, so then we had the slide of the free cash flow and the capital allocation, and here we could see that the company had about 1.75, 1.8 billion in free cash flow, and this is a enormous year-over-year growth. This is not really realistic. It's not like this is an actual representative number. Now, in the next slide, I will show you the free cash flows and make it more compatible to previous quarters. But let's just first go through this. Now, they state that they had free cash flow of 1.8 billion, which included a 100 million net negative timing impact between originating European buy now, pay later receivables, but also that the free cash flow and adjusted free cash flow was positively impacted by higher earnings and lower cash taxes. Okay. So on a trailing 12-month basis, free cash flow of 5 billion and adjusted free cash flow of 5.4 billion. And this is quite important, as in Q1, they repurchased about $1.5 billion in shares. And on a trailing 12-month basis, share repurchases came out to 5.1 billion, reducing the average share size by 5%, or share number by 5%. And they also mentioned the plan to stick with it, to at least buy back another 5 billion worth of stock. Now, this will, of course, enormously help their EPS numbers, but is also inspiring and creating confidence to investors. So it's overall a good thing. But just let's compare last quarters or last two quarters under Alex Chris with the quarters previous to it. Okay, so what we have here are three charts or three graphics. I have taken those from Qualtrim. I like that software a lot because it visualizes things very easily. And the first one on the top left is their free cash flow in orange and their stock-based compensation in blue, so that you can see how much they are diluting the free cash flow. Now, next to that is free cash flow per share. So on a per share basis, how much free cash flows do they have? Because, well, in my opinion, that's a very good and almost the best way to generally see what the value per share of a business should be. And then at the bottom, we have the free cash flow per share, but adjusted to include the stock based compensation costs. Okay, what I want you to look at is that these last 2 quarters, stock based or free cash flow has been going up, and free cash flow not as much, because here we can see that free cash flow overall over the last 2 years has been going down a bit over the last 2 years by 10%, but this is just, well, down 10% over the quarter 2 years ago. But stock based compensation is rising less rapidly. So that's overall a very good thing. And what we can also see at the free cash flow per share is that this actually started increasing again, because this has been flat for quite some time. I mean, if you look at the chart, you can barely see a trend upwards in it. So this is something that they will have to, well, adjust and correct going to the future, that it started creeping back up again, that it looks like some exponential growth. And if we look at that adjusted number, or stock based compensation adjusted number for free cash flow per share, we can also see that the last 2 quarters have basically been very high compared to the quarters before it. So that's overall a very good thing from Alex, Chris, and his team. Okay, so if we look at the guidance that PayPal gave, we can see that they expect low double-digit EPS growth and approximately 6.5 to 7% revenue growth. Well, 6% spot basis and 7% currency neutral. For the full year, they expect mid to high single-digit growth in non-GAAP EPS towards $3.65, and they say that last year they had $3.83, but this is with the old methodology, and they have some slides where they correct it all and set it next to last year's numbers under the new methodology. So it's kind of looking twisted, because they expect in 2024 to have GAAP numbers of $3.65, which, well, that would mean they have less EPS, or a lower EPS number than they had last year. But the good thing is they expect cash flows of approximately 5 billion and at least 5 billion of share repurchases. Now, what has to be said is that during the conference call, they did not expect the interest rates to stay as they are right now, and that the gap in differences of interest rates will be closed from last year. Now, you might ask why this is important, but all companies invest their money into treasuries. And as PayPal has $17 billion in cash, having that higher interest rates really makes a difference on those earnings. Okay, so then what we have to look at in this slide is the take rate, because we can see that the take rate of PayPal, which has been a large part of, well, some bear cases, the take rate is still going down. However, is it that big of an issue? I think it's quite natural and something you should expect. They just have to outgrow the lowering of take rate, and the take rate shouldn't be a sudden, unexpected, really large drop. Now, there were other things that were very positive about the earnings and in this report, and that is the transactions per user. They grew their customer base, or their user base, slightly. I think it was 1 or 2% year over year. But what most stood out to me is that they now had 60, or on average, 60 transactions per month per active user. So that's going up at quite a rapid pace. And that's very good for the business, because that means that the underlying business, besides the economics of it, of course, but the underlying fundamental business is actually gaining speed, or still going at speed. And that the job that Alex Chris has to do here is more around the economics of it than fixing the actual business. There is nothing wrong with the business, just with the economics of it. Now, that was it for PayPal. So let's just go to Apple because, as I mentioned in my newsletter, they kind of butt their way towards positive news, positive headlines. Okay, so the Apple earnings report. Now, this was expected to be very bad. I have seen headlines saying that iPhone sales in China would be down 30% for the month. And what quite simply said that didn't really happen. Now the earnings weren't great. Don't think I tried to make it look good because the earnings per share year over year was as flat as it could get. I mean, the basic earnings per share was 153 compared to 153, and on a diluted basis, it was up 1 cent. So basically, EPS didn't go anywhere. And sales have been down for all the hardware products. However, they had one ace up their sleeve, and that was the services side, the highest margin side of the business. This was actually up about 10 to 15%. So at the services sector, they actually did it really, really well. The balance sheet of Apple has been getting cleaned up a bit. If we look all the way at the bottom, well, one line above the absolute bottom, we can see that stockholders' equity has increased a bit. So where does that come from? Because if we look at the asset side, we can see that the current assets has been coming down a bit, mainly due, if I look at it, due to the accounts receivable, but that's only a good thing. And the non-current assets have been going down a bit as well. Also, namely, marketable securities are down about 5 billion. Now, this is not bad, especially not the downtick in accounts receivables. But if we look at the liability side, this is especially where it has been going down excessively because the accounts payable, well, that has decreased massively by about 17 billion. That's a huge number, and that's simply great that they did this. So overall, I don't think this has been a bad quarter for Apple, but more so in cleaning up the balance sheet or further improving the balance sheet. Maybe not so much in the numbers for their hardware. Okay. But like I said, they bought their way to positive headlines. And what do I mean by that? Well, basically, they just announced a $110 billion buyback program. A $110 buyback program. That's the biggest one we have ever seen from any company. Now, we know that Apple does huge buybacks and they have immense buyback programs because that's their way of returning capital to shareholders. Because, well, they didn't do it by their dividend because they increased it 1 cent per quarter. But $110 billion buyback program. That's immense. That's just buying your way to positive news. Okay, so then let's go over the two companies I genuinely dislike. And the first one is Square. And with Square, it's mostly in their financials. Well, with both, it's more so in their financials, but with Square especially because I think they offer great products. They bought Afterpay, which they converted to Riverty, if I'm not mistaken. I use it myself. It's a lovely product. What the company does is very good. What they do for investors, less so. Now they are improving. I have to give them credits for that. They are improving. But if we look at last year, they completely diluted away their non-GAAP earnings. Their non-GAAP EPS looked good. Was around the $1.80 mark. And then when they converted it to GAAP, where they had to include stock-based compensation, it was basically 2 cents. They just dilute it completely away with stock-based compensation. They compensate or they do so much stock-based compensation, it's incredible. They keep no cash flows for themselves, basically. This quarter they did, and that's why I have to give them a bit of credit. But I just generally don't like the way they handle their financials. Okay, so let's just look at them very quickly, and maybe I can show in the numbers what I mean by it. So, starting off, they say that share based compensation expense has been and will be a significant recurring expense in their business and an important part of their compensation strategy. So, what they are saying is, yeah, we know we dilute you as a shareholder a lot, a ton actually in their case, but we will just continue doing so and you will just have to handle it. Your stake in the company will be made smaller and smaller. Where we say Apple does a ton of buybacks, and over the years, well, your percentual ownership of the company just increases steadily. Square diluted you for 5% compared to last year. They have issued, or their share count has increased by 5%. So your ownership in the company decreased by 5% over the last year if you didn't sell or buy any shares. We have EPS of 74 cents this quarter compared to 16 cents last quarter. Now, this is where I said they actually improved. But if we go one line below it, we can see that they now have 637,000 outstanding shares compared to 623 last year. So this is where I say the dilution comes from. Your ownership in the company simply gets diluted by quite a bit. Okay, so the last slide, those were GAAP numbers, and now we have the non-GAAP numbers, and this is where I can kind of show you what I meant. Because right now, if we look at the diluted non-GAAP EPS, we get to 85 cents. This was 75 cents or 77 cents in the previous slide or in GAAP numbers. But when we look at last year, they went from 16 cents GAAP EPS to 43 cents non-GAAP EPS. They more than doubled, about 1.5 times as much non-GAAP EPS as GAAP EPS. Now that's just painting a completely different picture. And how do they do so? Well, they just include a bunch of numbers, and every company does this. This is not purely a Square problem, but what they do is just include a massive amount of stock-based compensation. They just had $300 million of stock-based compensation on $470 million of net income. They just give out so much stock. It's incredible. Now, another company I genuinely don't like their way of accounting is Carvana. And what's the problem with this company? Well, basically very simple. Because if we look at their balance sheet, we can see that they have less assets than they have liabilities. So, to say it more simple, they have more liabilities than assets. They have improved slightly from last year because if we see the stockholders deficit, it is somewhat improved. But overall, it's very simple to say that this is very bad. And if we look at the income statement, it gets worse. Okay, so why would I say that it gets worse? Because if we look at the top, we can see that retail sales are actually improving and wholesale sales or wholesale revenue is also up compared to last year. So then what's the big deal? Well, the big deal comes at the lower part, and that is in their interest expense. Or let's start up some lines above it. Because the operating income was 134 million dollars, but they have interest expenses of 173 million. And that's an issue because they have more interest expenses than operating income. Okay, so what happens next? Well, they will just have to pay it off, right? They will have to pay their interest expense and lower their debts. Well, yes. And here comes an issue, because let me go back to the balance sheet. Okay, so why is it such an issue? Well, if they have around $170 million in interest expenses and 135 million in operating income, there's a gap there, right? And they will just have to pay it. But with what do you want to pay it? Because they have 250 million in cash. That's not a lot of cash. And what else is happening is that the long term debt is going to expire at some point. And besides that, they also have a current portion of that debt that they also will have to either pay off or refinance, but nobody is gonna want to give them financing. So this becomes a huge problem. And the part where I genuinely don't like this is how enthusiastic they are about their numbers. And they include all kinds of adjusted EBITDA. Well, EBITDA is the most adjustable number in and of itself. And then you even further adjust it to paint a decently good picture. It's, well, it's not fraud. It's just very rosy accounting. And it's something that I just really don't like. And seeing the stock popping up 35% only makes me think of one thing, and only having the possibility of one thing, and that is that they are simply burning shorts. Because this company has had a short interest, according to Yahoo Finance, of 35%. So having that many shorts in it, giving it a little push, will bring the stock up a huge amount, because you get huge buying pressure if all those shorts get underwater. Now, with all that negative stuff being said, it's time to end this video on a positive note, and that is that my website is online. And on this website, I publish the research that I have been doing into the companies of which I share my analysis. It's the video I post every Wednesday, and it's a new stock I do analysis on. Now, that research is posted on my website, and if we just look at it, we can see what it's basically going over. So, it's going more in depth on the research or on the analysis I give on my YouTube video, as I already mentioned. And to me, it's a way to make sure that you can invest with decent knowledge of the companies you have on your watch list. Now, the focus of these analyses will be on tech and growth. It's not some value prospect, but I will mention to buy it at decent valuations. And I also try to make a decent case for a good valuation at the end of each analysis. However, that won't be on YouTube, that will only be there. Now, I also have my morning market feed, and this is where I go into everything that I have been or I have seen in the markets the day before. This is what I post here on Monday to Friday, and I simply, like I said, go over all the things that I see, I found notable, and I try to bring it in a bit of a skeptical way so it's easy to digest. Now, if you want to check out my website, it's in the link down below. And if you are there, make sure to sign up for the newsletter to be able to receive it as the first one, or to be first to receive all that news and all the things I try to put out. Now, that was it for today. Thank you for watching. I hope you have enjoyed it. Make sure to like and subscribe to my channel. And I hope to see you next week.